Bitcoin has slipped below the $67,000 level. Ethereum has fallen under $2,000, and the broader crypto market is once again under pressure. But this time, the selling isn't being driven by exchange hacks, regulatory crackdowns, or crypto-specific scandals. Instead, the pressure is coming from something much bigger: the U.S. macroeconomic outlook, a shift in Federal Reserve expectations, and growing concerns about tighter liquidity ahead. In today's report, we'll break down why Bitcoin dropped below $67,000, what Kevin Warsh's nomination signals for markets, what derivatives data is revealing about leverage, how ETF flows are behaving during this dip, what institutions are waiting for, and what key macro data could decide the next major move. Let's begin. Bitcoin and crypto market performance. Early Wednesday, Bitcoin fell below the $67,000 mark. At one point, BTC traded around $68,800, down approximately 3.1% over the previous 24 hours. Ethereum declined even more sharply, dropping 4.1% to trade near $1,965. Other major cryptocurrencies followed. XRP fell roughly 4.3%. BNB declined around 4.5%. This wasn't isolated weakness. It was broad-based selling across large-cap digital assets. And, importantly, this decline came during relatively stable equity conditions. So what triggered it? The macro shift, hawkish Fed expectations. Analysts point toward a shift in expectations surrounding U.S. monetary policy, specifically the nomination of Kevin Warsh as Federal Reserve Chair. Warsh is widely perceived by markets as more hawkish, meaning more cautious about rate cuts and more focused on inflation control. A hawkish signal typically implies tighter liquidity, higher for longer interest rates, fewer or delayed rate cuts, stronger dollar pressure, and reduced appetite for risk assets. And cryptocurrencies are highly sensitive to liquidity conditions. When liquidity tightens, speculative assets often face pressure first. That appears to be what we're seeing now. Why liquidity matters for Bitcoin. Bitcoin trades not just as a technology asset, but increasingly as a macro liquidity proxy. During periods of easy monetary policy, capital flows into high-risk assets, leverage increases, funding rates rise, Bitcoin rallies. During tightening cycles, liquidity contracts, funding resets, leverage unwinds, risk assets correct. This week's move aligns with that second scenario. Derivatives market, a deleveraging event. According to Vincent Liu, CIO of Kronos Research, derivatives data suggests a large portion of excess leverage has now been flushed out. Funding rates have cooled. Leveraged long positions have been cleared. This type of deep deleveraging can actually be healthy for the market. Why? Because excessive leverage often exaggerates price moves. When leveraged traders are forced to close positions, liquidations accelerate selling, volatility spikes, price overshoots temporarily. But once leverage resets, markets often stabilize. That may be what traders are now watching closely. Key support zone, $60,000 to $65,000. Analysts are now monitoring the $60,000 to $65,000 range as a critical support zone. This area has previously acted as a consolidation region, a liquidity cluster, and a psychological demand zone. If Bitcoin stabilizes here, it could form a base for recovery. If it breaks decisively below $60,000, macro pressure may intensify. For now, the market is in a wait-and-see phase. ETF flows, a stabilizing factor. Interestingly, spot Bitcoin ETFs recorded net inflows. On Tuesday, spot Bitcoin ETFs saw approximately $88.56 million in net inflows. That was higher than the $145 million recorded the previous day. Ethereum ETFs saw more modest inflows, about $13.82 million. These numbers suggest that institutional exposure is not collapsing. However, inflows alone are not enough to drive a strong rebound. Institutions appear cautious. They are not aggressively accumulating. They are waiting for clearer macro signals. Institutional positioning. According to market commentary, large institutional players appear to be holding back. They are watching for sustained ETF momentum, clear signals from U.S. labor data, direction from Federal Reserve communication, and broader equity stability. Institutions typically move after confirmation, not before. Retail often reacts emotionally. Institutions wait for catalysts. Right now, clarity is limited. Equity market backdrop. Meanwhile, global equities presented a mixed picture. Asian markets moved higher. South Korea's Kospi rose over 1%. Hong Kong's Hang Seng edged slightly higher. Japanese markets were closed for a public holiday. In the United States, the S&P 500 fell 0.33%. The Nasdaq Composite dropped 0.59%. The Dow Jones Industrial Average rose modestly by 0.1%. This divergence reflects broader uncertainty in risk appetite. Retail sales data and macro signals. Weaker than expected U.S. retail sales data showed consumer spending remained flat in December. Flat consumer spending raises questions about economic momentum. But paradoxically, weaker data does not automatically mean rate cuts. If inflation risks remain elevated, the Fed may still hesitate. Markets are now highly sensitive to incoming data, especially labor market figures. Why Thursday's labor data matters. Traders are closely watching upcoming U.S. labor market figures. Strong labor data could reinforce a hawkish stance. Weak labor data could increase expectations for easing. Interest rate expectations directly impact Treasury yields, dollar strength, risk appetite, and crypto valuations. Bitcoin often reacts quickly to shifts in rate expectations. Current market sentiment. Sentiment has shifted from optimistic to cautious, but not outright panic. There are no signs of systemic stress, no major exchange failures, no regulatory shock. This is macro-driven repricing, and that distinction matters.
Macro repricing tends to be gradual. Crisis-driven sell-offs are abrupt. Is this a trend reversal? It's too early to call this a structural trend reversal. Bitcoin remains well above major long-term cycle lows. ETF flows remain positive. Institutional adoption trends remain intact. However, near-term volatility is likely to remain elevated. As long as macro uncertainty dominates, markets will remain reactive. What could spark a recovery? Several catalysts could trigger stabilization: softer than expected labor data, dovish Fed communication, sustained ETF inflows above recent averages, dollar weakness, and declining Treasury yields. Absent these signals, price may consolidate. Risk factors to watch. Investors should monitor U.S. inflation readings, Federal Reserve speeches, Treasury yield movements, dollar index strength, ETF flow trends, and derivatives funding rates. These indicators provide early warnings of momentum shifts. Bigger picture: Bitcoin in a high-rate environment. One key question remains: can Bitcoin thrive in a higher-for-longer rate environment? Historically, Bitcoin has performed best during periods of expanding liquidity. If rates stay elevated longer than expected, growth may slow. But structural adoption remains a long-term tailwind. This creates a tension between short-term macro pressure
and long-term digital asset adoption. Bitcoin's drop below $67,000 is appearing to be primarily driven by macro expectations. The nomination of Kevin Warsh as Federal Reserve Chair has reinforced hawkish sentiment. Derivatives markets have seen deep deleveraging. ETF flows remain positive but cautious. Institutions are waiting for clarity, and upcoming labor data could determine the next major move. For now, markets are digesting the macro shift. Volatility may persist, but the broader structure remains intact, pending further economic signals. As always, this is a developing macro-driven environment. We will continue monitoring Bitcoin price structure, ETF flows, Federal Reserve policy shifts, and institutional positioning. If you found this analysis valuable, consider subscribing to Bitcoin Legacy for in-depth macro-driven crypto insights tailored for US, UK, and European markets. Stay informed, stay disciplined, and I'll see you in the next report.